we've certainly seen a return of the IPO these past couple of weeks and months. Part of that was actually interesting, the result of the government shutdown. A lot of the stuff that had been coming down the pipe kind of got stuck at the SEC for a while. And that's kind of why you're getting this wave pretty much all at once through April, May of major IPOs. I don't really want to go over the debacles that were Lyft and Uber, or in some ways the mind-blowing rise that's beyond belief or beyond meat. And so I think it's more instructive to think about what you want to do when you see an IPO. And assuming if you're watching this on our website, you're not getting the IPO shares because we don't do investment banking. So you would be looking at them in the secondary market. And here's the things that I would keep in mind. Number one, this IPO wave changes the supply dynamic of the market in a very meaningful way. Pretty much for the last few years, we've seen what I would call a unilateral or a monotonic decline in the availability of public equity supply. Companies have been buying back shares, which reduces the float, and companies disappear through mergers and acquisitions activity. Private equity will buy a company, or company A will buy company B. And if they use cash, that reduces the supply of equity. On the other hand, this is kind of the opposite. Equities that had not been public are coming out, which increases the supply of publicly available equities. If nothing else, if you're fully invested and you want to buy an IPO, you have to sell something to have the money with which to buy it. So that does change the supply and demand dynamic. And so right there, you have to think, how has the market changed in terms of when you see a large IPO, is there a need for potential investors to raise cash to participate in it? And then on the more micro level, in terms of the company-specific viewpoint, I think we've learned the lesson that it's dangerous to buy the hype. That's not always the case. Again, Beyond Meat kept soaring and soaring throughout the pricing process, and then even afterwards. Whereas Lyft, I think one of the biggest problems that we saw with that IPO was that the market price kept rising and rising, and that the deal price kept getting raised and raised. And then when it came out, there was almost no way for the stock to sustain that enthusiasm. Part of it has to do with size. The ride-sharing IPOs were huge. And so that requires a lot of investors to put in money into the IPO, into, I guess, the secondary market, because the IPO investors have already been placed. And so you need that big wave of secondary money coming in to take the stock price higher. And the bigger the deal, the harder it is to get that kind of momentum. Also, and I think in general, it's important to understand what you're buying and whom you're buying it from. Most of these deals that we're seeing are private equity venture capital sponsored. The thing you pretty much want to take away from that is they know more about market dynamics of that company and the bottom line than you do. You can argue that that's the case in any IPO, where management knows more than the public who are buying it. That's pretty much normal. But it's a very different dynamic if you're buying it from the founders of the company who are basically looking for a way to diversify their holdings, as opposed to venture capitalists who've been riding this thing higher and now decide they needed someone else to sell it to. So be very careful of that. Look at whom you're buying it from. Look to see, is there a path to profitability? Is there a technology that they have that is specific to that company that can't be duplicated? And these are the decisions you have to make. And be very careful about chasing. Just because it sounds hot doesn't necessarily mean that that's going to be a good investment. It may be a good trade, but it may not be a very good investment, especially when you're talking about some of these companies that have difficult paths to profitability. Trade carefully.